Okay, this is the self-test for Chapter 3. You may, if you've looked at these already, this is the first one I think I have out right now, but you'll notice that the questions are in different orders. There may be questions that aren't on here because it draws from a pool. But this is the best I can do to kind of walk through each of the questions in the self-test and explain the answers. A second disclaimer here, I don't have an answer key to these, so I'm taking the test as if I were a student. It's possible for me to make errors, and so what I'll do is when I get to the end, I'll click grade, and if I've made any mistakes, we'll go through and discuss why they are mistakes. So it's important for you, if you're watching this, if it gets boring for you and you have it all figured out, then you might want to still go through to the end and make sure I didn't make any errors. I don't want to throw you off. So there's my disclaimer. So let's go through self-test for Chapter 3. Expenses decreased retained earnings. We know that that is true because the retained earnings come from our beginning retained earnings plus our net income minus our dividends, and that'll give us our new retained earnings. And so expenses have the effect of decreasing the net income, which will also decrease the retained earnings, so that's true. Number 2, the effect on the basic accounting equation of performing services for cash R2. So remember, the basic accounting equation is assets equal liabilities plus equity. So if we perform services for cash, then our asset cash will increase and our revenue will increase, which will increase our retained earnings, which is part of our stockholders' equity. So there'll be an increase to assets and an increase to stockholders' equity. And number 3, Genesis Company. I'm not sure if that's Phil Collins in Genesis or like Old Testament Genesis, because I think the two are quite different. But that's just an opinion. Maybe you think that both are that important. Anyway, Genesis Company buys equipment for $900 buys equipment for $900 machine on credit. Okay, that's not me. It's just weird grammar. The transaction will immediately affect the blank. So if they're buying equipment, the asset will go up, and the liability, if they're buying it on credit, will also increase. So this will only affect the balance sheet, right? There won't be any revenue or expense until we start to depreciate the machine. That will create an expense, but immediately no revenue or expense. So anything that says income statement is out. So this is balance sheet only. Number 4, which of the following events is not recorded in the accounting records? Equipment purchased on account is definitely recorded in the accounting records. An employee is terminated, that would not be recorded, right? Because there's no financial change there. Cash investment, now there may be financial changes that come about because of the termination, and those would be recorded. So you have to, with accounting, you have to try to avoid the temptation to go to the next step. You always have to take it step by step. The actual termination of the employee would not create an accounting entry, so it would not be recorded. Cash investment definitely would be, and the owner withdraws cash, so that would be. So it's just B, the employee is terminated. During 2014, Gibson Company assets decreased by $50,000 and its liabilities decreased by $90,000. Its stockholders' equity blank. Okay, so kind of the easiest way to think about this is we have to remember the fundamental, or what do they call it in this book, the basic accounting equation. Yeah, basic accounting equation is assets equal liabilities plus equity. So if we said our assets went up by 50,000 and our liabilities decreased by 90,000, what would be the change to our stockholders' equity? So I would just write this out as a basic kind of algebraic formula where A equals L plus E, and I would substitute 50,000 for A and negative 90,000 for L, and then solve for E. And that would come out to E equals 140,000. So our equity must have increased by $140,000 if those things occurred. Number 6, retained earnings is decreased by. Remember, retained earnings is beginning retained earnings plus net income minus a dividend. And another way of saying that is beginning retained earnings plus revenues minus expenses minus dividends, right? Since net income is revenue minus expenses. So retained earnings is decreased by expenses, not by revenues, not by assets, and not by owners' investments. 7, if an expense is paid with cash, then assets will decrease. That's true. Retained earnings will increase. That's not true. Liabilities will increase. Nope. And expenses will decrease. Nope. So assets will decrease. What asset? Well, cash. So our cash goes down, and since there's not a corresponding liability being paid off, then it must be out of our stockholders' equity in the form of retained earnings. Anytime we pay an expense, that reduces our retained earnings. So if an expense is paid with cash, assets will decrease. If cash is received in advance from a customer, so the customer pays us before we've done anything for the customer, then our asset cash will increase, and our liability, usually it's called something like unearned revenue, will also increase. So assets will decrease. No. Retained earnings will increase. Nope. Liabilities will increase. Yes. Right? So that transaction would look like asset increase, liability increase. And there'd be no change to the retained earnings. Number 9, receipt of unearned revenue. Okay, that's what we were just talking about in 8. Increases an asset and increases a liability. Yes, right? That's what we just said. Our cash will go up and our liability, unearned revenue, will go up. Payment of a dividend. So when we pay a dividend, that's our cash going down and our dividend going up, okay? Which has the effect of reducing our retained earnings as well. So when we pay a dividend, there'll be an increase to expenses. No. A decrease to cash. Yes. And an increase in stockholders' equity. No. A decrease to cash and a decrease in retained earnings. Yes. Number 11, if a company receives cash from a customer before performing services for the customer, then, so again, we've talked about this already, but this is our unearned revenue again. Our cash will go up, which is an asset, and our liability, called unearned revenue, will go up. So our assets will increase. Stockholders' equity will not change. Assets will increase and the liabilities will increase. They really like that. They've given us that question 3 different ways. Number 12, if total liabilities increase by 5,000, then, so if our total, remember, assets equal liabilities plus equity, so if our liabilities increase by 5,000, then we either have to have an increase in assets by 5,000 or a decrease in liabilities at a different liability by 5,000. That would be like you got a new loan and paid off an old loan with it. Or there would have to be a decrease in stockholders' equity by 5,000. That would be the only options. So assets will increase by 5,000 or stockholders' equity will decrease by 5,000. Those are both true. Every account has a left or credit side and a right or debit side. That's true. Every transaction affects at least 2 accounts. Also true. An account is part of the financial information system and is described by all except which of the following? An account has a debit and credit side. An account is a source document. An account consists of 3 parts. An account has a title. So an account is not a source document. Source document are those proof we need to create entries in an account, right? So a receipt would be proof that we bought something, or a invoice would be proof that we billed the customer, and so forth. Those are source documents. Number 16, which statement about an account is true? In its simplest form, an account consists of 2 parts. I think it's 3. An account is an individual accounting record of increases and decreases in specific asset, liability, and stockholder equity items. That one's looking pretty good. There are separate accounts for specific assets and liabilities, but only one account for stockholders' equity. We know that's not true because we know there's common stock and retained earnings at the very least. And the right side of the account is the debit side. We know that's not true. The left side is the debit side. So it's going to be B. An account is an individual accounting record of increases and decreases. 17. Assets are increased by credits. Assets are increased by debits and decreased by credits, so that is false. 18. Debits increase both assets and liabilities. That's not true. Decrease both assets and liabilities. That's not true. Increase assets and decrease liabilities. That's true. Okay, so a debit increases assets and decreases liabilities. Let's see, a revenue account is increased by debits. Let's see, let's just think about it. Revenues are increased by credits, decreased by debits. So let's see, is increased by debits? Not true. Is decreased by credits? Not true. Has a normal balance of a debit? Not true. It's a credit for a revenue account. Is increased by credits? True. Remember, the normal balance is always the side that is the increased side. So if an account, like a revenue account, is increased by a credit, then that's the normal balance for the revenue account as well. All right. Which accounts normally have debit balances? So we would expect all the accounts that are increased by debits to have a normal balance on the debit side. So that would be assets, expenses, and dividends. There it is, D. What effects occur when an account payable is paid with cash? So remember, an account payable is a liability. So if we pay that liability with cash, then our cash will decrease and our liability will decrease. So stockholders' equity won't change. There will not be an increase in assets if we're paying out cash. So it will decrease our assets and decrease our liabilities. There it is on D. 22, accounts with normal debit balances include. So again, the normal debit balances are assets, dividends, and expenses. So it's not assets and liabilities, not liabilities and expenses, not stockholders' equity and revenue, but expenses and assets. There's a lot of D's. All right, accounts with normal credit balances include. So that would be the liabilities, the stockholder equities, and the revenue accounts. So liability and stockholder equity. It's revenue and assets isn't true. Revenue and expenses isn't true. Assets and liabilities isn't true, so it's C. 24, an account has $300 on the debit side and $900 on the credit side. How much is the account balance? So remember, we would just take the higher side and subtract the lower side. So we know we're going to have a $600 balance, and since the higher amount was on the credit side, the balance will be $600 credit. At September 1st, 2014, 50 Inc. reported retained earnings of $136,000. During the month, 50 generated revenues of $20,000, incurred expenses of $12,000, purchased equipment for $5,000, and paid dividends of $2,000. What is the balance in retained earnings at September 30th, 2014? So for this one, I'll just use an Excel spreadsheet to make my life a little easier. If I can do it, let's see. All right, so they had, at September 1st, they had retained earnings. That's the beginning retained earnings of $136,000. Remember, we add net income, which in this case, we're going to have, I'll just figure it out over here, revenues of $20,000, expenses of $12,000, and then the purchase of equipment is there to throw us off, okay? If they purchased equipment, that is not an expense. That is a expenditure of cash on an asset. So our net income, which I'm sure you could have done in your head, but is 20,000 minus 12,000, which is $8,000. So we're going to add our net income. We're going to subtract the dividends of 2,000. And our ending retained earnings will be the beginning retained earnings plus the net income minus the dividends. So $142,000. And that, since it's retained earnings, that's on the credit side. All right, which of the following is the correct sequence of events? Analyze transactions, post to the ledger, record it in the journal. Analyze transactions. We know analyze transactions is first, right? Then we put them in our journal. Then we put them in our ledger. Or record transactions in the journal, then analyze them, then post them to the ledger. So it's going to be B, analyze them, put them in the journal, and then record them to the ledger. What is evidence that a transaction has occurred? That is our source document. All right, so that was a self-test. Let's grade it and make sure I got them all right. And if I missed some, then we'll go over them. Looks like I missed a couple, so I made a mistake. Let's see. All right, during 2014, Gibson Company assets decreased 50,000 and its liabilities increased by 90,000. Decreased. Oh, you know why I made a mistake with that? Because I said that they increased by 50,000. So it should be, if again, here, let me bring up the Excel spreadsheet again. So I'm glad I made a mistake. This will help me give you another chance to fix it. So if I say my assets equal my liabilities plus my equity, and then I say that my assets, and again, when I did it at first, I tried to do it too quickly. I did it in my head. I wrote an increase, but in this case, it's a decrease of 50,000 to the assets. And the liabilities are a decrease of 90,000. And so if we solve for equity, then we will take 90,000 plus the negative 50,000, and that's going to be that the equity equals 40,000. And that's our increase. So I'm kind of glad I made that mistake so I could walk you through it a little better. And then it looks like I made one more. Every account has a left or credit side and a right or debit side. That was tricky because I was thinking that it was every account does have two sides, but they tricked us and put them backwards. So every account has a left or debit side, and every account has a right or credit side. So there we go. We have to read them very carefully. And I think that's all we missed. Okay, so there's the whole test. Hopefully the walkthrough was valuable. Have a great week. Let me know if I can help you.